Hold on. Natasha, good to see you, Natasha. Anna, James, Geneva, Arno. Let's see here. Carol, Elhaj, Sharon, Eileen, Demetrius, Jesinia, Nina, Emily, J. Kelly. Let's see here. Let's see. Faith, Gary, Hayden, Juice Joint. LLC. I assume that's not your name. I assume that's the name of your company. All right, very nice. I love it. Amani Walker is in the chat. Amani is part of our support team. She is here in case you have any questions or any concerns or any issues that come up. Don't forget, in the Black Business School, if you have any issues or any questions about anything, just email support@theblackbusinessschool.com. Support@theblackbusinessschool.com. Keep that email around. Amani informed me this week that our average response time to emails is 7.5 hours now. So that's really good. We've increased that or improved that. So I want to stay at that standard. I want us really getting back to you quickly so that we can help you as much as possible. So if you have a question about a program that you're in or a program that you're thinking about signing up for, we got a whole team there that's waiting to talk to you and to nurture you and support you in your journey. Now, and the two big things that I've mentioned in terms of things that we think we can help you with is one, I mentioned to you all that there's kind of a retirement thing going on right now where a lot of us are not as prepared for retirement as we want to be. So I'm actually going to create some stuff around retirement planning and then retirement management once you're already there. And then also younger people between, say, 20 and 40 are struggling to buy property because housing prices have gone up so much. So, and I mentioned to you all in this morning's money mindset financial consciousness training about sort of this considering this idea of buying property together. I think that's a great wealth hack. It's very easy. It's as simple as knowing that 2 plus 2 is 4, and that 2 plus 0 is still 2. So, so if you need 4 instead of having 2, then you get somebody else with a 2, and next thing you know, you can compete in this capitalist thing because capitalism is based a lot on group behavior. So you want to find your group, find your crew, etc. Now, one thing I also want to warn you guys about too, not warn, I want to tell you, I want to talk about it and then also warn you about it, is how many of you own Bitcoin? Bitcoin's been just killing it lately. It's been an amazing investment, and I love it. It's nice when things do what they're supposed to do. Like I've always felt that Bitcoin was going to keep going up, and I feel like this 71,483 is something that was long overdue. Bitcoin was supposed to really hit 71,000 probably 5 years ago, honestly, maybe 4 years ago. But things happen. The government gets in the way, or economic downturns happen. And what's so funny is that Sam Bankman-Fried, who's about to go to jail for swindling people and taking their money, the dilemma that they have right now with Bankman is that all the investments that he made with that money have actually come back up. And he's actually made a profit for all the people that he took money from. So it's like somebody stealing your money and running to the casino, and then you find out that they actually doubled it. And so, but they still stole your money. So Bankman-Fried is still going to go to jail. But I wonder if that's going to be taken into account of that he actually made investments that are doing quite well right now. All these markets are coming back. And you look here at Bitcoin over the course of the year, a 61% ROI. That's beautiful because it wasn't hard to predict. It was very easy to see that Bitcoin was going to keep coming up. Also, there's what they call the halving. The halving is coming up, HALVING, where they're going to cut the rewards for mining Bitcoin in half. And what some believe is that by cutting the rewards, it's going to naturally increase the price. It's going to create a floor of about $75,000 because a lot of miners are just going to say, I'm not going to mine any Bitcoin unless I can get at least $75,000 or something, per coin or something, right? So effectively, this halving is supposed to reduce the supply and natural flow. Every time there is a halving of Bitcoin, the price goes up about 400% the following year. So with this halving coming up, it's in April, I think. I don't have the date in front of me, but when that happens, I would say that it's pretty safe to say that there's a good shot that if you're on the Bitcoin train by then, your money will grow tremendously, probably faster than the stock market. And so those are the bull cases of Bitcoin. I am a Bitcoin bull, but the thing is that there are risks of Bitcoin too. And what I want to talk to you guys about are the risks. And the reason that this came to mind is I saw my good brothers from Earn Your Leisure. One guy, the master investor. I don't have his name in front of me, but he's a smart guy and I like him. And he said that the old 60/40 model of a portfolio needs to go out the window. The old model was that you put 60% in stocks, 40% in bonds. And he said that model needs to go out. Ian Dunlap. Thank you, Calvin. Yeah, Ian Dunlap. Yes, smart guy. I like him a lot. And he said that 60/40 model needs to go out the window, and I would put 40% of my money in Bitcoin. And I said, uh, um, I would be very careful about that for a couple of reasons. And I'm really saying this as a researcher who's looked at data over, from over 100 years. Um, that's been said before, not about Bitcoin, but about other investments. What happens every generation, especially when there's what they call irrational exuberance, whenever the market does really well, there's always a school of thought where people say, "Oh, traditional finance is out the window. The old models are no good. We need to. The world has changed." And this happened, in the 1920s when you had the Roaring Twenties and everything was going up, and when you have people in environments like that, people that are conservative end up looking silly. Nobody wants to hang out with the party pooper. If everybody's drinking and having fun and having a good time, nobody wants to hear from the person who says, okay, let's not drink too much, let's not get too carried away. So here's the deal. But then obviously the tone changed during the Great Depression. The bubble pops, everything goes flat, and then the conservative people end up looking like the smart ones. They're the canaries in the mine. So different investing philosophies make the most sense in different environments. And so the reason I would say be really careful with Bitcoin, and I want you to always understand with investing, there's always a yin, there's always a yang. It's just like the moon. There's the light side and there's the dark side. So you always, when you make an investment, you always want to see the dark side too. Like what could go wrong? And here's the problem that a researcher like me would have with something like Bitcoin. There's just not enough data. There's not enough. This asset is a young asset. It's not like, you know, uh, Coca-Cola stock that's been around for over 100 years where you kind of know what the dynamics are. You can look at the statistics, you can look at the volatility, and you can analyze the skewness and understand the distribution, like of all the things that can happen with Coca-Cola stock. You have entire theories around how financial markets work, things like the efficient markets hypothesis and all that. I'm not going to get into that because I don't want to, it's not necessary. But basically, Bitcoin and crypto is a very dangerous market because it's not a well-established market. All of the variables that determine what a quality market looks like, transparency and liquidity and things like that, this market doesn't have those things. This is like moving into a dangerous neighborhood because there's lots of money in that neighborhood, but you might get robbed in the alley because you don't know what's going on in that community. So Bitcoin has been around, yes, since about 2009. That's not very long. That's not very long. It's still very high risk, and I'm not putting more than 5 to 10% of my portfolio in Bitcoin ever. I don't think that that would be a good move. I'm not telling you what to do. I'm saying that if you do it and it collapses or something bad happens, just know that I said that to you. Okay, and this is something that I say that there's a reason that these traditional models have survived over 100 years. It's because they've existed through various market conditions, and there have been speculative environments in the past. The one of the first ones was about 300 years ago. People got really excited about owning tulips, and everybody for whatever reason they started buying these freaking tulips at insanely high prices, and they thought the price would keep going up because basically they would buy tulips assuming that someone is going to pay more than they paid for their tulips, and eventually the market collapsed and the price of tulips went down to what they really should have been, which is pretty much almost nothing, and people lost their entire fortune. So this happens all the time. I would encourage you as an investor to observe what's going on, ride the waves, jump on the trends a little bit if you want to, be there for the party for sure. I'm a big believer in Bitcoin, but never get so carried away that you don't understand that there's a dark side to everything. And Bitcoin has a massive dark side. The government could step in and literally just create laws that make it almost illegal to trade Bitcoin, and then the prices would collapse. Now, what does protect a little bit more is the fact that institutional investors have now started to get involved. So that reduces the risk a little bit. but the risk is still there. And the other thing too is the same thing happened actually with China. China is a very established economy. China's an amazing economic ecosystem, but I don't know if you've been following what's been happening in China. Right now, China is in the toilet in terms of markets and risk. um, there are people in the United States and around the world who have lost billions investing in China. My family personally, we lost $150,000 investing in China. We invested in a company that was making insane amounts of money for us because I was selling options on the stock. I've told you about this before. What was that? Tekadu. It was a company I never heard of it. They sell educational services for families after school or something. And China just came in and just decided that they didn't want to have people profiting from the after school programs anymore because they felt it was too stressful for their kids. Imagine that, a society that actually makes laws to the benefit of their children. We don't do that here in the United States very often. And then Tekadu stock went from $31 to 3. And I did not have put options on it. But I made enough from selling the options on it that it balanced out. It was kind of like a basketball game where you thought you were going to win by 40 points, but you end up winning by 2. It was kind of like that, right? And so a lot of investors are now wondering if China is even investable anymore because the tensions between the US and China are so great that things can change at any moment. At any moment, the US can make some new law saying that we don't want you to ship the technology over to China, which kills someone's business. Apple's Chinese iPhone sales have dropped dramatically because in China, they just said, well, we ban all of our government officials from using iPhones because we don't want them spying on us. And now in the United States, you see what's going on with TikTok. And I don't know if you've been following that. The United States government is asking TikTok to divest, or they're asking ByteDance, the Chinese-owned company, to divest their ownership share in TikTok and sell it to someone in the United States because they don't want the Chinese to have access to data and consumers. And so what happened after that, and I'm kind of stream of consciousness. I'm doing a stream of consciousness here. So if you wonder why I might jump from topic to topic, that's kind of what's happening. So I hope that's okay. So so effectively with TikTok, one of the things that was interesting was that what the TikTok owners did in response to the possible ban is they got all their users, they hit the users up with notifications and said, call your congressman, bombard them and tell them not to ban TikTok. Well, all that did was that just made Congress that much madder. That made them that much angrier. And it really proved their point. It proved their point that they have this outside entity, this outside government that is interfering in their political process. So that really actually increased the probability that TikTok's going to get banned. It did not reduce the probability. So ultimately, do I think TikTok's going to get banned in the US? I don't know, but I do know that in China, most apps from the United States are banned in China. You cannot use Facebook in China. You cannot use Instagram in China. You cannot use YouTube in China because these apps do have data and they do have the ability to influence consumers. Okay, so anyway, so a couple things in terms of if you want to know my fundamental assumption on Bitcoin. Yeah, I'm accumulating Bitcoin. I buy it every single day. I think that buying Bitcoin is a wonderful thing. This is not investing advice. This is just what I'm doing. But at the same time, I'm not betting it all on Bitcoin because I don't think that that is a safe strategy, given that there's still a lot we have to learn about this market in general. There are lots of people. In fact, there are people like Warren Buffett who don't believe in Bitcoin at all. He literally looks at Bitcoin as a purely speculative asset, although that's debatable. What Buffett says is he says, if I buy a company, I'm buying a real asset. I'm buying something that is making a product that's generating revenue. It doesn't matter if the market doesn't think that this company is worth anything. I'm still going to have something of value, right? Um, or if I buy this house, even if there's no market to sell the house in, I still have a house. I have bathrooms and square footage and the bedrooms and all that I can use. I can still get an ROI from my investment, even if there is no market. He said with Bitcoin, if there is no market, you get no ROI. If it's not for the fact that there is somebody out there who might buy your Bitcoin from you for a price higher than what you paid, then there's no point in buying it. Seriously, let me ask you all this question. Give me a yes or no. If I told you that that no one will ever pay more than $71,840, let's say that's the price. If I told you that no one will ever pay more than $71,000 for a Bitcoin, would you buy Bitcoin right now? How many of you, yes or no, would you still buy it if I told you that the price was never going to go up, if there's no chance on earth that you can buy this for or sell this to anyone for any price higher than the price you'd buy it today, would you buy it? Would you buy it? Would you make that investment? No, you wouldn't. You wouldn't buy it because what you're doing is you're engaged in what some almost call the Ponzi scheme like atmosphere of investing, which is I'm just going to look for someone who's going to pay more than what I paid. That's what it is. And eventually you run out of new suckers, so to speak, who will pay more than what you paid, and then the market collapses. That's the argument. But I don't know if that's necessarily true because Bitcoin has shown a tremendous amount of staying power. And I think that Bitcoin is a worthy investment. I just don't think it should be 30, 40, 50% of your portfolio. I'd say that if you put, in fact, nothing should be 40% of your portfolio, honestly, in my opinion. I just don't think, I think that's when you cross the line from investing to gambling. That's when you've gone in to use, the terms that we use as professors. You've gone from what they call efficient risk to inefficient risk. You're gone from necessary calculated risk to unnecessary sloppy risk. You understand? So diversification is a long-held, proven investing strategy that tends to do quite well. Okay. All right. So what I'm going to do is answer a few of your questions here in the Q&A section. So let's see here. When selecting different stocks each week, wouldn't you become an ETF? And the point is to beat the market on a yearly basis. Wouldn't have so many stocks lower your percentage of beating the market? That's a good argument. I get that. It's really a philosophy thing. It's debatable. Some people will say yes, some people will say no. Some people will say, yeah, if you just keep buying different stocks all the time, you're going to have so many stocks that you're just going to move along with the market. You're not going to beat the market. But then there's actually a whole school of thought that says that it's silly to even think you can consistently beat the market anyway. You might beat it sometimes, but then sometimes you won't beat it. And then over time, you're going to average whatever the market's doing or whatever the risk profile is for the particular stock types of stocks you're buying. So if you just buy tech stocks all the time, then on average, over time, most of you will make about the same that the tech industry makes. So if the tech industry goes south, your portfolio will go south. If it goes north, then your portfolio will go north. And so I would almost say that you could, if you want it to be a hands-off investor, you could just buy into index funds and ETFs and leave it at that, and just and only look at your portfolio once every 2 or 3 months. I've seen people that do that. Sometimes it's better. That's better investing because in many cases you make more money that way. A lot of people lost money in Bitcoin because they kept picking at it. They would sell it when the price went down, or they'd only buy at certain times, and when everybody was excited about it. But really, if somebody just put $5,000 down on some Bitcoin back in 2014, you'd be a millionaire now. You'd literally have so much money. So sometimes just not poking it, not picking at it. Like a little scab on your arm. Just don't stop picking at it. Just let it heal. Let's see here. What do I think about this morning's CPI report, which came in at 3.2%? Great question, Errol. I did not see the CPI report. Let me look here. I don't know what I think is really coming down to what the expectation was. So 3.2%. I don't think that's horrible. I know the stock market went up 200 points, so that means the market overall didn't dislike it. I don't know what the experts' expectations were. So, but that's a good one. That's a great point. Thank you for bringing that up, Errol, because that was actually the biggest variable in today's market is what's the CPI number going to look like? Because there's a big debate right now about whether or not the Fed is going to reduce interest rates or not. And a lot of it comes down to whether or not they feel the economy is stable and that inflation has dropped enough that they can safely either not increase anymore or B, actually reduce interest rates. And that is based on the assumption that somehow we just believe that they have to be reduced. I think that's a faulty assumption. Honestly, I don't know why we have to have lower interest rates per se, but generally speaking, that CPI report is really important because if inflation came in hotter than it was supposed to be, that's an indicator that they don't need to reduce interest rates because they're worried about inflation getting out of control. So the way the economy works is that typically if you have a strong economy, your big worry is that inflation will be too high. It's like driving a car. Inflation is like putting your foot on the accelerator, but if you put it on the accelerator too much, you not only get to your destination faster, but you might crash. So when they're trying to boost the economy, they actually try to create a little bit of inflation to kind of get stuff going, but they don't want to create so much inflation that they crash the car, so to speak. So now We've got a strong economy. The U.S. economy has been roaring like crazy. We have the strongest economy on the planet. We're doing far better than all of our peers out here, and that is a good thing. But the downside, though, is that we have this inflation bug that we're trying to stamp out. And they feel like they have to stamp it out before they start actually reducing interest rates, because the reduction of interest rates increases inflation. And that's actually what you do if you have a recession. If you want the recession to go away, then you reduce interest rates, which stimulates the economy, which creates inflation, which gets your car moving down the road, right? So right now they don't know what to do. Their fear is, if we wait too long to reduce interest rates, then the economy could end up the economy can end up suffering, because high interest rates slows the economy down. But there are other fears that if we reduce interest rates too soon, we could have an inflationary problem, which would be tough to rein in. So they really don't know what to do. They're really kind of stuck, and this is something that experts are debating like crazy. I don't get the sense that these numbers, these CPI inflation numbers, are bad, because if they had been bad, you would have seen the stock market really take a hit. I almost get a sense, and I gotta just keep reading more stuff to see what the experts expected. Um, but I get a sense that it's about close to expectations. Let me see here. It says in CNBC, the Consumer Price Index, a broad measure of goods and services, increased 0.4% for the month and 3.2% from a year ago. The month measure was in line with expectations. Remember, just like I was telling you. The fact, see, here's the thing: you can tell a lot. The market talks to you. The stock market talks to you by basically letting you know. If it throws it, it's like a baby. If a baby starts crying, you know something's wrong, and if the baby's laughing, you know the baby's happy. Well, if the stock market starts crying, which is a dip, if it starts going throwing a temper tantrum, then you know that something bad happened. So literally, my first indicator was, I said, okay, let me see what the market did in response. Oh, the market went up, so the market must be okay with these numbers, right? Because if I'd seen red and someone said, oh, the market crashed by 500 points, I'd be like, oh, so there's a reason. So remember this: whenever your stock drops, there's always a reason. Whenever the market drops, there's always a reason. So the assignment for you is, whenever you see something drop, I want you to take the time to go look up the reason. And that helps you with your economic understanding by seeing what happens, why these prices have moved so much. So basically, they said that the core CPI rose 0.4% and was up 3.8% on the year. Both were 1/10 of a percentage point higher than the forecast, which isn't bad. A 2.3% increase in energy costs helped boost the headline inflation number. Food costs were flat, while shelter climbed another 0.4%. Okay, so shelter and energy are going up. Food costs have remained flat. Yeah. So, and in fact, actually, if you log in at the blackstockmarketprogram.com, I did put a list of stocks under what Dr. Boyce is buying, and I focused a lot of the stocks on industrials and energy stocks. And that's mainly because I have reason to believe that these are going to be great investors over the 3 to 5 year horizon. So just log in at theblackstockmarketprogram.com, look under what Dr. Boyce is buying, and you can find that list for this week. Let's see. How do you make believe currency like Bitcoin? That's a deep question. Yeah, I honestly, I'm still I read a whole book about Bitcoin to understand it when it first came out, and about the blockchain and all that. It's genius. It's brilliant. I still don't completely understand like how people just will create currency. Like, I mean, I kind of get it, right? Like, currency typically has to be backed by something, and then what happens is it circulates through some sort of ecosystem in exchange for goods and services, right? So literally, we could create our own currency to some extent, and actually, you already do. You have things that are of value that you barter with and stuff like that, which creates almost like an alternate kind of currency. In fact, in communities where they don't have a lot of money, barter becomes a very powerful way to get out of the ecosystem that confines them a little bit. Like, if you're in a community where there isn't a lot of cash, you have to remember there's a lot of other things that can be offered to other people that are not cash like, right? So you can actually create an economy around all different kinds of currencies. And you can actually create some sort of paper or metal that you can trade that is backed by something of value in that particular space. So if we're all a bunch of computer programmers, we could create a currency where it's backed by programming hours, or something like that. And so maybe amongst all of us, we can just trade this currency and know that this unit, these coins or whatever, are what they call stores of value, which means that every coin should entitle me to a certain number of programming hours or something. Or you can create a currency around prostitution. You can create a currency around vegetables. Like a bunch of farmers could have their own currency that's backed by ears of corn or something, or pounds of carrots, right? So there's ways to do it. Um, Unfortunately, what's crazy though is you can also have currency that's kind of backed by nothing, which is what the dollar is. The dollar's not backed by anything. They didn't like that constraint. So what the dollar is backed by is the full faith and belief in the federal government. And so if you believe in the federal government, you believe they're gonna be able to make good on the money, then that's where you're gonna be. Now, I see someone mentioned Luther mentioned options. Yeah, we do. We meet for stock options in the Prime program. So if you text the word options to 87948, we are going to have a Prime meeting very, very soon. And also, we're doing the Stock Options Summit in Los Angeles, April 19th. So if you go to stockoptionsummit.com, you can join us there. Today, we're doing stocks, but we are going to do options. I don't know if it's this Thursday or the Thursday after next. I believe it's the Thursday after next. Maybe Amani, if you could put if you have the data, or Chanel's around, if you could put that in the chat, I'd appreciate that, because I don't remember exactly what day they scheduled. But very soon we're gonna have a meeting for the Prime program. We had a meeting last week, and if you log in at drboyceprime.com, there is a new list of money makers in there, options or stocks where you can sell the options and make income. And I show you pretty much what I'm doing. And these are assets now. Right now, they're kind of struggling a little bit. They've actually dropped a little bit, but this is where your puts kick in. But remember, the drop is something that we've been talking about for a while, because you had an extraordinarily good stock market for 18 weeks. 16 out of 18 weeks, you literally had you literally had prices going up, up, up. That hasn't happened since 1971. So whenever you start seeing stuff going up, up, up like that, just wait for you just got to know the other shoe is going to drop. Okay. All right. So let's see. Infalme says, it's not a question, but check out my portfolio when you get a chance. Okay. All right. So I can't go through every single stock in here, but um okay, so you got energy and industrials. Okay, that's a good start. I don't have much to say about the portfolio except for the fact that it looks like you have diversified across industries, which I think is great. And now remember, you can also buy ETFs and index funds that will diversify for you, but it looks like you've picked your stocks on your own, which I think is good. I see some good companies in there. I would try to make sure you have some S&P 500 exposure for sure, because those companies just tend to be good at making money. But right now, what's going on is that a lot of the stocks that are not part of what they call the Magnificent Seven, that a lot of these stocks are the ones that are expected to really turn around soon, after a while. Like right now, they've kind of slumped even during the time where companies like Nvidia were just shooting through the roof. And there's a belief that some of these companies were ignored in favor of the big tech stocks. Some of the tech stocks like Apple are not as strong as they used to be. Now, I'm a believer in Apple, though. I bought some more Apple stock when Apple was suffering, because I think Apple's going to surprise us. I think Apple's going to come out with some sort of big AI announcement where they're going to jump into the AI game and kind of take it over like they did with cell phones and everything else. And they're one of these companies that's able to be late to the party, because they don't have to compete with anybody. They can arrive fashionably late and still take it over, just like they did with cell phones. They came in, BlackBerry was dominating the market, and Apple pretty much came in and said, well, we're Apple. We have this new thing called an iPhone. We believe that this is going to be the phone people are going to start using. It's like, you can dump your boyfriend because your husband has arrived. It's that kind of thing. So Apple kind of comes in with that sort of arrogance, and it works. So I personally think Apple is going to come out with some sort of big announcement in the AI space. I believe they're also going to do a stock buyback and maybe do something with their dividend, with all the extra cash flow that they have, that's going to make their stockholders happy. So I'm comfortable being an owner of Apple and also acquiring more shares. Demetrius, what are some of cryptocurrencies that are not as popular as Bitcoin that are worth investing in? I tend to stay near the top. Again, I'm not a crypto expert, but I really like stuff like Ethereum, and I think Solana is doing well. I own some. I got to go double check it. I don't get into the meme coins, the Doge coins, and all that, even though they've gone up. but those are the ones that are going to bust the first, bust the fastest. Because remember, when in the crypto winter, Bitcoin maintained its value. The other ones didn't. A lot of them just went straight to hell. Bitcoin and Ethereum maintained their value because there's something there. Some of these other cryptos, there's literally nothing there. Would you still buy Max in MAXN? I'm going to work on buying 100 shares so I can sell options on it. Max in. Okay, I don't know what company that is. I can't remember. There's a lot of stocks we talk about, so let me look it up. Let me look up Maxin. Maxin. Okay. Maxin. Maxin Solar. Oh, okay. This stock. Yeah, this one's struggling. Yeah, I wouldn't buy it. This isn't what I'd buy. I mean, you could sell options on it. You could still sell options on it and get a lot of money on it. But the problem though is remember, whenever you're getting like a really good return on something, you got to ask yourself like what's really going on. And I can already tell you from what I'm seeing, this looks like a company that's losing money. Their earnings per share drops every quarter. They're not, and they're based in Singapore, which, these international companies are riskier. So if you were to do something like that or participate in this fiasco of a company, I would make sure that you have put options in place. Just protect yourself. Just, like you're going to hanging out in the brothels, make sure you bring a condom. I know that's a horrible analogy for some of y'all, but I think that's an appropriate one for what we're talking about. Just, I'm not going to judge you for going to the brothel. Just protect yourself. How about that? All right. So, Sherelle, would you still, okay, you already asked about that. Sorry. Sherelle, I said your name twice. Henry Irvin, would it be a good strategy to invest in SPY, SPDAR, or VOO for your kids or grandkids? Heck yeah, Henry. Heck yeah. Go to blackwealthmasterplan.com, blackwealthmasterplan.com. That's the $5 a day plan that we have in the Black Business School that will make your family rich. All you got to do is follow the basic instructions, be consistent, don't sell anything. Your family's rich in less than a generation, and you get all the credit. And then what you do is you celebrate yourself. You go ahead and put together a little estate plan and tell them that they got to like get like a statue or a painting of you or something and put you up as the big patriarch or matriarch that made it all happen. Like literally that you deserve it because I mean you had the vision, you're the visionary of the family. And then when the grandkids can go to college without paying a nickel or they don't have to go to work every day, they can say the reason I don't have to go to work is because great granddaddy Henry way back in 2024 did the $5 a day plan and that put us on a great trajectory. So blackwealthmasterplan.com. Also, if you want to invest for your kids, which I think you shouldn't just invest for your kids, your kids should be investing for themselves. The earlier they start, the better. 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 Why am I hammering the table and why am I yelling like this? Or I'm not yelling, I'm just acting weird right now. Here's why I'm acting weird. I'm acting weird because I'm trying to help you see what I see. See, here's what I see. People they just do it wrong. They tell young people they're like, if you start investing at 20, if you listen to like a Dave Ramsey type person, they'll say, and I like Dave. I don't dislike him at all. But he's not a professor. I teach the Dave Ramseys of the world. So what they'll say is stuff that you'll find in a textbook like if you start investing at 25 versus 35, this is how much more money you'll have by retirement because the person that starts at 25 is going to get such a head start on the 35-year-old that the 35-year-old can never catch up, even if they make double the contributions and blah, 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 blah. That's established. That's in every textbook everywhere. Um, Again, though, to help you understand the difference between learning from a professor versus learning from someone who just read books, is that professors, we write the books. So we don't just know what's in the books. Everybody knows what's in the books. We know what's not in the books and what could be in the books and what should be in the books. So what should be in the books is not, that the best thing you can do as a young person is to start planning for retirement at 25. What should be in the books is that you should start investing at negative 25 years old. That gives you a 50-year head start and you're going to have so much more wealth than if you start at 25. What do I mean by that? Well, let's just do half of that. Let's say they start at baby age. A lot of you who've been investing with me and been talking to me, I talk about that all the time. You have a newborn baby, start investing for them from day zero. Start putting that money in that SPY, VOO, S&P 500 fund. That child's rich by the time they're 25. That kid never has to work for anybody. You did it. Congratulations, you're now rich. Easy, very easy, not hard. Doesn't involve voting for the Democrats or Republicans, doesn't involve begging your boss, doesn't involve having, an NBA contract so you can get out the hood. It's simple, straightforward math. That math saves you, okay? But the reason I say negative 25 is even more ideal is because all you need in your family is a visionary. That's all you need. If you have a visionary in the year 2024, then they know that, okay, if I'm 30 years old or 25 years old, I'm going to have kids or grandkids that are going to be born, in the year 2035, 2040, 2045. If you're over 30, your grandkids are coming. They're going to get here. So what you do is you start investing for them at the age of negative 25. Not for them, but you can invest for yourself. It's your money. You can use it for whatever you want. But resources are meant to be passed in the intergenerational framework. Resources are things that benefit one generation, and then you pass it to the next. It's like if I have a car and I don't need the car anymore, I give you the car. I just take care of it while I have it. Right? Do you understand? So so resources get passed on because you can't take it with you. So you enjoy it, you invest for yourself right now, and you build the wealth up. And then when you're done, your time is up. You say, here you go. Here you go, grandbaby. You're 12 or 18. Have a nice life. I've been building this up for us, not just for you. I've been building it for us. I built it for me first, and then I'm giving it to you. And I've been doing this since 25 years before you were born. Then you're passing down millions of dollars. And I don't care how poor you are. I don't care. You could be making below minimum wage and be passing seven figures to your grandkids if you follow that basic idea. Do you understand how much wealth a person has if you have 50 years of compound interest? Are you kidding me right now? I only do 40 years in the $5 a day plan. The $5 a day plan, $150 a month, 40 years, 30 years, it's a quarter million, 40 years is $750,000. That's $5 a day. But if you talk about 50 years, I don't know that I gotta go do the math. I'm gonna guess that if 40 years is $750,000, I'm gonna guess 50 years is at least $2 million. That's it. And I'm gonna tell you this. See, some people, these are the Negro naysayers who find a problem with every solution. I can't listen to them very much. They make my head hurt. They'll say, well, $2 million isn't gonna be anything in 50 years. Try me. 2 million, well, $2 million is a lot of money in 1974. It's a lot of money in 2024. Sure, $2 million could have bought you a whole lot more in 1974, but it could still buy you a lot of things now. So believe me, $2 million in the year 2074 is still gonna be a decent amount of money. The average black person in America is not gonna have $2 million in the year 2074. I can guarantee you that. I can guarantee you that. So what I'm just saying to you is all it takes is thinking ahead and planning. My wife bought her first house with the money that her grandfather invested in 1942. And all he did was buy some World War II savings bonds, and then he didn't sell them. And then 60 years later, his granddaughter was able to buy her first house. So he made her a wealth builder by having a little bit of vision and just having a basic plan. He wasn't even thinking about her when he bought it. He didn't even know her. She didn't exist. Her father didn't even exist at that time, I don't think, or maybe he was a newborn baby. So so none of this stuff that he was investing for doesn't. So here's the thing. Here's what I want you to understand. Every morning when we do economic consciousness training and money mindset and all that in the morning, um, I'm not just teaching you how to invest for things that you see. I want you to invest for the things that you don't see. I want you to be able to see the things that you can't see. So I want you to be able to see the grandkids that you can't see right now. You don't know what the future holds. You don't know how many kids and grandkids. You don't know. In 1942, all he knew was the boogie woogie boogle boy from Company B and all that. He didn't know anything about the year 2002 and all that. He didn't know anything about it. He just knew that as a man, building wealth for his family was going to put them in a better position, and he didn't know how that was going to play out. He built on what he knew. So he said, let me buy some savings bonds because this is going to help my family in some way. And he could have been even thinking about himself. Maybe in 10 years, by the year 1955, I'll have some money. Maybe that's what he was thinking. And it's okay to think that way. It's okay to be selfish when it comes to investing. You're supposed to benefit from this too. But then what happens is that these other amazing things occur, that long term you pass these assets down to kids and grandkids, and it's an absolute game changer for them. She did not have to spend years as this struggling black woman who had nothing and was starting from the bottom of the barrel because nobody made a plan for her. You got to have a plan. So this is the thing that this is I'm very passionate about this. I'm very emotional about this because it's so easy and so simple, and we just have to do it. So just start doing it, something really basic. Again, the website is blackwealthmasterplan.com. It's free, it's there. Take a look. Again, if you want to teach wealth to your kids, text the word youth to 87948. That's another thing. Again, I don't know of any other institution that's doing this, but in the Black Business School, we want our kids trained on wealth. You want your kid to know how to start a business by the age of 12. You want them to invest as early as possible and to be a stockholder. And you tell them that you are a stockholder. You tell them that you're an owner. You tell them, you put these values in their head, like you are an owner of Disney, you are an owner of Amazon, and that shapes how they view the world. That shapes how they see themselves. They don't go through life seeing themselves as somebody that's supposed to be owned by other people. Most of our people think that way. I really believe that. I think that if all I'm doing is I'm teaching you how to go get a job working for someone else, I'm pretty much saying, well, someone else is going to own you and own your fate and own your time and tell you what to do and let you know when you can be happy and when you can't be. And I don't think that's a healthy way to raise anybody's child. So let me keep going. I hope that that was helpful. Thank you for giving me a chance to express that. Um, do you do day trading? Nah, not really. Day trading turns my stomach. I don't like losing all that money. That's not, here's the thing. Yeah, what's your strategy for ensuring the probability of profit? Okay, so let me tell you about day trading. All right. So first off, we do have a Forex program in the Black Business School that's run by a great guy named Michael Edwards. B1forex.com, be the number one forex.com if you want to take a look at that. We offered the Forex program because a lot of you asked for Forex and you some of y'all like the day trading and stuff like that. And I said, okay, well, as long as somebody can teach it to you in a way that minimizes your risk, then why not go for it? As long as you understand that there's risk. Michael is that guy, and he helped us. We partnered with his company, King Licks. I don't know how to pronounce that. Kingleflex. I don't know. Anyway, he has a Forex trading academy, and we partnered with him to create the B1 Forex Academy, which is at b1forex.com. So feel free to go take a look at that. Um, I personally don't do day trading because I find that my risk preference is just not in that category. Like I'm not 25 years old where I'm trying to get rich. I'm 52 years old and I just want to stay rich. And so if you think about it like a basketball game, when you are losing the game, you play differently from if you're winning the game. If you are, in a football game and you're three touchdowns behind, you're going to throw the ball more, you're going to take chances. Or in basketball, you shoot a lot of 3-point shots to try to get back in the game. Whereas if you're ahead, if you're 30 points ahead, then you run the ball, you shoot layups, you want to be really careful. Do you understand? You minimize your risk, right? So that's the stage that I'm at. And also, it's not just the stage I'm at, but it's also who I am. Right. So a lot of investing is emotional. A lot of investing is psychological. It's just how do you feel? That's why we have the whole Black Financial Therapy department, because we want therapists to help you get in touch with your feelings so you can understand how you feel as an investor. So you'll also understand that there's no one size fits all approach to any of this. Right. So don't ever let anybody tell you that you're stupid for the approach that you take. If you're scared, it's okay to be a little bit scared and say, no, that's not really for me. So I don't like the feeling of losing money when it comes to day trading. It just doesn't feel good to me. However, people that want to minimize the risk, one of the strategies that they might use is they have a lot of stop losses in place where they will do a trade and they have rules that they follow. And it's very important. If you have these rules, you got to be really disciplined with it, where they'll say, if I'm 50% up, then I get out of the trade. If I go 50% down, then I get out of the trade, right? I don't try to see how the story ends. I don't try to hold on to see if I make a comeback. I'm just going to get out of there because I've lost too much money and I'm not interested in that. And also, they have rules about how much of their portfolio they're willing to put on the table any given time. So, what they might do is they might have a rule that says, I have $10,000 in investable capital. I'm not going to put more than $200 toward any particular trade. That way, even if I get hammered, I'm not going to go too far down or too far up. I'm going to kind of maintain my capital base because, as I've mentioned to you all before, one of the most important parts of investing is protecting your capital base. Or to use a sports analogy in football, the most important job of the quarterback is not to throw passes, not to score touchdowns, is to protect the ball. You got to protect the ball before you can do anything else. So, and I get this, right? I get some of this because ironically, I've mentioned to you all that I'm a good poker player. I like poker. It's a great game of psychology, strategy, and math. I don't like to pay poker for money because gambling addictions are very unhealthy. That will destroy your economics. But I like the competition. I like getting in there, outsmarting people, and playing mental games. Trying to see if I can intimidate people or whatever, or get them to underestimate me or whatever. Right? And it's fun. I've won big tournaments and all that. And one thing about poker that's interesting is that a lot of brokerages in Wall Street were recruiting poker players to come to Wall Street to trade stocks because they said good poker players have the same characteristics that are necessary for good traders. And the characteristics they look for are the ability to minimize your losses, right? To know when to fold them, right? But also maximize your gains, know when to hold them. Right? Know when to hold them, know when to fold them, know when to walk away, know when to run. Right? And these are literally great rules that apply in poker, and they also work in trading as well. And you know that song, "The Gambler." That's the song I was singing, "The Gambler" by Kenny Rogers, right? And then he said that part where you never count your money when you're sitting at the table. There'll be time enough for counting when the dealing's done. I laugh at that song because it reminds me. I'm gonna tell y'all this quick story. I hope it's okay. I was in Montana and I sat down. Was it Kenny Rogers? Okay, so I sat down. I sat down with these cowboy looking dudes in the middle of Montana, in the middle of nowhere, because my wife and I were there for something. I forgot why. And and they didn't know. See, I'm deceptive because nobody assumes the black guy has a PhD in finance and can do crazy mathematical calculations in his head, right? And I don't let them know any of that. I just sit there quietly and I don't even talk because if they hear you're articulate, maybe they figure that you're smart, so they won't engage with you, right? So I'll sit there, and I sat there and I started playing, and within 1 hour, well, I think I sat there. I was going to sit there for an hour. I told my wife, I said, okay, come back in an hour, and then we'll go to dinner. Within 1 hour, the $100 I had turned into like $1,000, right? So I'm sitting there with this big stack of chips right in front of me. I'm the one black dude, and all these like white cowboy looking guys are looking at me like they are pissed. They're livid at me. And I know I assume what their mindset is, because the other thing too is like I could tell like for them like losing $200 or $300 like a really big deal. For me, it was like, yeah, you win some, you lose some, and they're starting to figure out that I'm better than I look, right? And so my wife comes back and she's like, "You ready to go to dinner?" And I'm thinking to myself, yeah, I want to go, but these guys might kill me and take my money. They're gonna be real pissed off at me if I just walk away while I'm up. So I said, okay, I'm gonna give them some time to make their money back. I'm not gonna give it to them, but I'm gonna give them some time. So I said, give me another hour. I just want to play for a little bit longer. So I sat there and I kept playing. So then the 1,000 had turned into like 1,800 or $2,000. So by this time, I'm sitting there and I'm just wiping the table clean, right? Luck is part of it, but skill is big too, right? So I'm just scooping up all these chips. I'm going all in on people and taking it. And they, I mean, by this time they're just pissed. They're just looking at me like we gonna skin you alive, boy. And so my wife comes back and she's like, okay, you ready to go eat now? And I said, I said, I'm sorry, guys. I gotta go. It was fun playing with you. And the guy looks at me, one of the country dudes looks at me with his cowboy hat and he goes, "Do you always do what your wife tells you to do?" And I was like, oh my God. So I thought about that song, "The Gambler." You got to know when to walk away, know when to run. I cashed in my chips and I said, baby, we need to hurry up and get in the car and get the hell up out of here because somebody's gonna rob us in the parking lot. So yeah, that's a real thing. Like, yeah, so anyway, that's my stupid poker story. I hope it's okay for me to share that. All right, so let me answer some more of your questions. I apologize for getting us distracted here. All right, so Let's see here. Next question is, can you provide an example of what you mean when you say you can lose everything when you don't meet the strike price for options? Are you talking about the premium or the actual stock? I could be missing something. Yeah, so with options, if you remember, with options, you are buying the right to purchase the stock at a certain price. So the option is a derivative. It is connected to the stock. So if it's a call option, if the stock goes up, the option goes up. If the stock goes down, the option price goes down. The difference between owning the option and owning the stock, though, is that if you buy a call option, if you, excuse me, if your stock does not hit that strike price and you hold it till maturity, you could literally lose every penny that you've invested. So that's the thing with options. You get a big reward if it pays off, but you have a lot of risk. You can lose a lot if it doesn't pay off. But your investment is minimal, right? So I could buy options on Amazon stock for $1, whereas Amazon stock doesn't cost me $1. It costs me a lot more. But when I own the option, I'm not an owner of the asset. I own the rights to the asset under certain conditions. That means I own the right to purchase the stock if it hits a certain price, or I own the right to sell the stock if it goes below a certain price. So if you want to dig into options and you're trying to learn more about it, we have a whole masterclass. I did a whole stock options weekend. Everybody loved it. It's at stockoptionsmasterclass.com, stockoptionsmasterclass.com, or also if you just text the word options to 87948, we've got plenty of options curriculum in the Black Business School. That's what we do. We're good at that. So just text options to 87948 and I'll send you some stuff. All right. So Robert, Isaac, I recently bought some AMD. I'm hoping that it will pop like Nvidia did. What do you think of AMD? I like AMD a lot. I think it's a great play in the AI space. I think that there is some possibility that it could have been overlooked in the midst of all the fury over Nvidia. Maybe waiting for it to dip a little bit might be a strategy, or maybe going ahead and buying some and dollar cost averaging your way into the stock could be a way to go. The problem with AI investing though is that a lot of AI stocks have very high expectations. And the risk that you have when you have high expectations on a stock is that if any little thing goes wrong, that sucker's going to crash. That sucker's going to crash. So just be really careful about the other day I was talking about the Black community and where we struggle educationally because of the curse of low expectations. They don't expect our kids to excel. They don't expect themselves to excel, so they don't excel in many cases. Well, we also have the curse of high expectations. Sometimes if your expectations are super high, you're at risk of being disappointed. Like, so I think about some of these AI stocks, almost like you ever see somebody that goes on like one date with a person and they start planning their wedding and thinking about how many kids they're going to have, and they start thinking about the next 30 years with this person they just met because because they just had such a great time, and in their head they just have all this, these plans, and then something goes wrong, the person doesn't call them back, and they're like devastated. And they're devastated. Why? Well, because you had all these plans in your head. You had this big bubble in your head of these ideas and this whole fantasy of what life would be like with this person, and then the whole bubble just popped. So you didn't just lose one date, you lost the next 30 years. That's what you lost. So a lot of these stocks are built on expectations. Nvidia's price isn't just based on what it's made to this day. It's based on what it's going to make for the next 30, 40 years. Do you understand? Like, so they're calculating all this and they're looking at the next 30, 40 years. They're saying, oh my God, AI is making so much money now. I will wait till the year 2028, 2038. It's got to be crazy, right? Well, what if something goes wrong? What if something changes? What if Nvidia is dethroned as the biggest player in the game? This happens. This happened in when the internet first became a thing around 2000. Anything with a .com attached to the name of the company, what instantly your stock price went to the roof just because you put a .com on the name of your company. So every company was like, we're boogers.com, we're hamburgers.com, we're going to be a .com in about a month. And so companies were doing that because it was pushing their stock price up. But the same thing is happening with AI. People literally are like, well, we're using AI for this, we're using AI for that. So they would measure the number of times companies would say the words AI in their earnings announcements, and it was skyrocketing because they knew that everybody was looking for something that was AI related, and it would boost their stock price. Remember, the number one job of a company manager is to maximize shareholder wealth. That's what they were doing. They were getting the stock price as high as possible by constantly using the words AI. But just like with .com, remember, the biggest players in the .com space in the year 2001 are not the biggest players in the .com space in the year 2024. If you'd asked somebody in 2001, do you think this .com stuff is going to be big in the future? They would have been like, heck yeah, it's going to be the biggest thing ever, which it was. It was. It absolutely positively was. Did not disappoint. But then if you said, well, which companies are going to dominate the .com space in 20 years, they'd have been like, oh, well, you know it's going to be AOL. You know, you got mail. They dominate the mail game. Oh, and then MySpace is going to be massive. They're going to grow like crazy. MySpace, by the year 2024, everybody's going to have a MySpace account. How many of y'all got a MySpace? Give me a guess. Anybody got a MySpace? Anybody got a anybody got a MySpace? Anybody remember Netscape? Remember Netscape? They were the bosses of the internet 20 years ago. No. And then if you went to the person and said, "Well, have you heard about Facebook?" They'd be like, "What is a Facebook?" I don't know what Facebook is. What about Google? Well, what is that? I heard that's that little tiny company that's that's just getting started. But what about Amazon? You think Amazon's going to be big? Oh, heck no. Amazon's losing billions of dollars a year. That company's garbage. They're going straight to hell. Their stock price is $2. Even Apple. Do you know how much Apple stock was around 2001, 2002? Let's look it up. I don't know. Let's see. I can't remember. Let's take a little virtual field trip real quick and let's do a little financial consciousness exercise so you can understand that the first thing that you want to know when it comes to investing is how little you actually know. Once you understand how little you know, that's the first step to gaining true knowledge. You have to understand how little you know. That's the biggest thing I learned when I became a professor is how little I know. So when you think you know everything, that means you know nothing. That's you know that's a red flag. All right. So here's Apple stock. Let's look at this. Apple stock. Let's go back to 2001. Look at that price. Okay, but first let's look at the price now. What's the price today? $172. 2001. What is that? Can y'all see that number? 39 cents. 39 cents. 39 cents. So if you told somebody in the year 2001 that this 39-cent stock is going to be worth $172 in a little more than 20 years, they would have thought you were crazy. So what I believe is that if you want to understand if you want to live in the year 2024 and understand the year 2040, you got to imagine yourself in the year 2000 and no, sorry. If you want to understand the year 2044, you got to imagine the year 2004 and ask yourself, how much did I really know about 2024? And the answer is nothing. You didn't know nothing. All you knew was the big picture stuff. You knew that the internet was going to be big. That's what you knew. And you were right about that. Everything else, you didn't know which companies were going to be the dominant companies in these industries. So right now, all you know in 2024 is that AI ain't going nowhere. AI is going to be dominant. That's what you know. But you don't know if Nvidia is going to be the dominant player in the year 2044. So a better approach to investing would be some sort of index fund, some sort of fund that connects you to multiple AI players so you're not trying to bet on one horse. You're not gambling, you're investing. So, so just for the record, if you want to, I can text you guys a list of AI stocks that I personally invested in. Just text the word stock to 87948. If you haven't done it yet, text stock to 87948, and I'll try to find that list of AI stocks again, and I'll send it out again today. Text stock to 87948, and I'll send it to you. All right, so let's answer a few more questions, and we're going to bounce out of here. I'm going to go and chill for a little bit. What is the best real estate investment trust to invest in? You know what, Jay Kelly, I don't have any in front of me right now, but I would say that something with Vanguard or one of the major companies is typically a great way to go. Yeah, I would look and see what Vanguard has or BlackRock. BlackRock knows how to make money. So I don't have any in front of me, but I'm sure I've got stuff like that invested myself. Let's see. Veronica says, Dr. Boyce, when you come to Los Angeles, how about asking the group, well, some like to share housing in Airbnb-like locations, saving more than renting, and we help each other do stock options and become homeowners. That's a great idea. Get with Amani, Veronica, and then Amani can keep some notes, and we can see what we can incorporate when we go to LA. We are gonna be in LA April 19th and 20th for the Stock Options Summit. It's gonna be a fun weekend where we're gonna do stock options, and you will walk away wealthier and smarter and understand so many different ways to make money that you didn't know about before. We're gonna talk about buying options, selling options, different option strategies. I'll tell you guys what I'm doing and how I'm making my money. It'll be like a great big financial slumber party. So we're just gonna hang out and have fun and just make money together. And to me, that's the greatest combination. So feel free to go to stockoptionsummit.com. That's stockoptionsummit.com. And also, if you just get on one of those text lists, I'll send you guys the link to join. And by the way, there's only 100 spots. We did not get a big venue, so the tickets will run out. We're all actually halfway done selling the passes, so you may want to get one sooner rather than later. Let's see, what websites are you using to analyze stocks? Okay, I use everything. I listen to podcasts. I subscribe to every financial podcast I can find that where the information is good. I read a lot of different publications from CNBC to Bloomberg to Wall Street Journal, all kinds of stuff. I'm just constantly absorbing financial information. So a lot of times what I also do to learn about stocks is while I'm doing something that doesn't require my brain, I'll just be consuming information. So sometimes I like to relax and play golf with my not Oculus, but it's called a MetaQuest, which is really fun. I play VR golf, and it got me back on the golf course. I had stopped playing because golf takes too much time. But while I'm playing golf, my habit is I'll put in my head. I have these little earphones, these earbuds. These are cool. These are bone conduction. They actually go through the bone of your skin. Not that this has anything to do with what I'm telling you. I just think it's kind of cool. And I put these bone conduction things on, and I just listen to financial information while I'm playing golf. So that's a good way to kill two birds with one stone. Also, I practice poker. My three hobbies, my three fun sports hobbies are golf, virtual golf though. I practice poker. I play online poker every now and then also I got back into Call of Duty. My homeboys, we play Call of Duty together. And while I'm doing all three of those things, I am listening to financial information at the same time, or I am on the phone with my loved ones. And that's because I have such a busy schedule. That's how I make sure I fit in the time for the things that I want to do. There's probably only five things in my life that actually matter, the five things that I make time for. And so, one is the consumption of financial information. The other is talking to the people that I love. Another one is working on stuff related to the Black Business School. Another one is my fitness and just getting to the gym. Another one is my family and my wife. And that's pretty much it. And that's a good life management strategy if you're interested. I encourage anybody who feels like you're being pulled in every direction and constantly being sort of yanked around by the world to pick those five or six things that matter to you more than everything else, and then try to see if you can just make that your whole life. Like shut everything else out, because that'll keep you from being just sort of consumed by everything. Like I have to do that because I have so many people that want to call me and they want stuff from me, and it's very, very draining. And then also on top of that, social media is it's always something dinging, buzzing, and beeping and pulling you like, oh, there's an email here, there's a text message here, there's a tweet here, there's a I don't, I turn off all notifications, every single notification on any device that I have, and I focus on those five or six things that matter. And that allows me to end the day feeling fulfilled, like, okay, I got something done in my life. And it also allows me to keep from being like I control my time does not control me. Right. So, but the downside is some people think you're a little rude because I never ever answer the phone because it's like, why? If 95% of the people that are calling me are only asking for something anyway, I need to make sure I'm pouring into my ecosystem. I got to pour into the business. I got to pour into my family. I got to pour into Boyce sometimes. And I can just tell you that you have to give to the world, but you can't give so much to the point where you get depleted. And that's a balancing act all of us have to find. So find that balance. That'll make you happy. I hope that that's helpful to you. All right. So let's see. Tanisha. Let's see. I'm a novice. Okay, what? That's okay to be a novice. That's okay. Sometimes being a novice is actually an asset. Which type of account should I open to invest in the S&P weekly, monthly? Robinhood, E-Trade, all those would do the trick. Acorns is very simplistic, very straightforward. Let's see, Stash isn't bad. You can do Fidelity. And literally, if you go to blackwealthmasterplan.com, that's the $5 a day plan. You could literally, Tanisha, you could literally set it and forget it. You could literally set your account to invest a certain amount of money in an S&P 500 fund, and the ticker symbol is SPY. That's one of them. There's others. and literally do nothing else, and you'll be wealthy in in about a decade. You'll have a lot of extra cash flow. Now, investing does take time. This is not a get rich quick class. This is not a quick flip, easy money type situation, but it is a consistent thing where you get rewarded for that consistency. And if you're consistent, it's like think about raising your money. Here's the last analogy I'm gonna give, and then we're gonna bounce on out. I know some of y'all still have some questions, but we'll get the questions next time because I wanted us to finish in an hour, and we're a few minutes over. Think about raising your money the same way you think about raising your child. That's the financial meditation I want you to do. I want you to imagine giving birth to a baby, and imagine if you say, I want to be a parent, I want to raise a child. First thing I want you to ask yourself is, if you really feed that child a lot of food, can you raise a full-grown child in 2 weeks? Like, what if you just fed them like cheeseburgers and carrots and breast milk and whatever, like and vitamins? Can you raise a child in 2 weeks? You can't. So when I see people that are looking for fast money as their financial solution, like quick flips, I'm gonna buy one stock and it's gonna quadruple in a week and I'm gonna have all this money. That's what I see. I see somebody that's trying to raise a full-grown baby in 2 weeks. That's counter to nature, counter to biology. It's not it doesn't work like that. I mean, people get lucky, people win the lottery and all that, but that's not how people build wealth on average. The way people build wealth is exactly how you raise a child. If you have a child, you feed that child on a regular basis. The difference with stock is that it's easier than raising a child because you don't have to feed the stock every day. You just got to feed it once a month or once every week or once every 2 weeks or whatever, whenever you get paid. And you can do it on autopilot. You don't have to babysit the stock. You just own it and you keep investing. They call that dollar cost averaging, where you set on your app a certain amount of money that's going to go into your S&P 500 fund, and you do it consistently, and then you just let nature take its course. And then what happens is, in the $5 a day plan, after 10 years, you're doing better than 99% of all Americans, or at least 90%, because you would then have about $29,000 liquid in your account. Most people in America do not have $29,000 liquid in their account. So in one decade, just investing the amount of money that is less than the amount it costs to buy a Popeye's chicken value meal can put you ahead of 90% of all Americans. So don't you ever tell me that you can't have money just because you're black. That's stupid. That's crazy. That's what people who don't understand economics will say. And then after 20 years, it goes up to about 100,000. After 30 years, it tends to go up to about 250,000, give or take a few thousand. It all depends on the history of the stock market and the era in which you're investing. So nothing's guaranteed, but this is a model that people have used to build wealth, and it works. It works. So if you want to visualize if you want to see what I see when it comes to building wealth, I want you to think about building your family fortune, building your generational wealth, the same way you imagine raising a child. And there's no person that's ever given birth to a child that would plan to raise that baby that thought that they were going to raise that baby in 2 weeks. No. So that's it. It's easy. It's easy. Again, it's like raising a child, except it's just so much easier. So go ahead and do that. Raise your economic babies, and then by the time that your life here is over, somebody will benefit from the fact that you had a little bit of economic vision and you made a plan and you did some basic things, and then all the money, all the wealth that you've enjoyed all those years, you just pass it on to the next generation so that they don't have to be slaves. People have to be slaves. They have to work for other people because nobody made a plan for them. There's no person out here who had somebody make a financial plan, who stuck with the plan, who has to get up every day and go to a job. That's just unless something went wrong, unless somebody wasted all the money, or in our case, honestly, there's a lot of theft, right? We know that white folks, not all of them, but some of them stole our stuff, right? So a lot of you had grandparents that were thinking the same way, who did save and invest for you, but all that was taken away. This is where reparations does come into the conversation. But putting that to the side, that's it. It's not, that's why people have to go to work. It's because they don't have a capital base. And that's what the capitalists at the top of the food chain really want. They don't really want you to be financially secure and comfortable. They need you to be uncomfortable enough that you got to come out of the house to come work for them, in order to make a living, right? So don't let them get you in that trap. Let's be smart about that. Okay. All right. So I'm done for today. If you want to join us for our morning money meditation, financial consciousness training that we do every morning at 10 a.m. Eastern, 7 days a week, just text the word morning to 87948. Text morning to 87948. Also, you guys know tonight, my wife, who is a licensed therapist, she trains other therapists. We created the Love and Money Lab to help you in areas related to love and money. A lot of us struggle in our relationships when it comes to money, and so we are going to meet tonight. If you'd like to get an invitation to that, just text the word love to 87948. Text love to 87948, and Dr. Alicia will send you some relationshipy stuff. We'll also send you an invitation to tonight's meeting of the Love and Money Lab. I don't have the link in front of me, so I'll just text it out to you guys a little bit later on this afternoon. So have a good day.